So what if I told you the biggest threat to the US economy right now isn't coming from Washington, isn't coming from inflation, and isn't even coming from the Federal Reserve, but from a bond market on the other side of the planet that most people don't even talk about. That's Japan. Because this week Japan just triggered a move that forced global investors to wake up. Japan's 40-year government bond yield jumped above 4%, something that hasn't happened since 2007. And for Japan, crossing 4% isn't just a number. It's a signal that the cheap money era is no longer guaranteed. Japan has been running the same financial playbook for decades. Ultra low interest rates, massive debt levels, and a bond market that was so stable. But now the market is starting to price something different. And that's where everything gets dangerous. Because Japan isn't just a big economy. Japan is a major supplier of global money. And the reason world got addicted to Japanese money is simple. Japan made borrowing unbelievably cheap. So for years investors could borrow in yen at almost nothing, then move that money into US assets that paid more. This strategy became so popular, it basically turned into fuel for growth markets. It boosted risk taking, it helped push stocks higher, and it also supported US Treasury demand. And it kept long-term borrowing costs lower than they otherwise would have been. So this is why Japan's bond market matters, even if you have never bought a Japanese bond in your life. So what changed? That trigger wasn't some random rumor. It wasn't even a central bank meeting. It was politics. Prime Minister Sanae Takaichi called a snap parliamentary election for February 8, and she didn't position it as a normal election. She described it as a chance to win support for major policy changes. Now here's what investors heard: more government spending, more stimulus, and more pressure on Japan's already insane debt situation. Because Japan already carries one of the biggest debt piles in the world, roughly 200% to 250% of GDP. That debt was survivable when rates were near zero. But in a world where yields start rising, the cost of maintaining that debt grows fast, and bond traders are not patient people. The moment they smell fiscal risk, they reposition immediately. That's exactly what happened. Investors started selling Japan's ultra-long bonds aggressively, especially the 40-year, and once selling starts, the math is automatic. Bond prices go down, yields go up. The 40-year yield didn't slowly grind higher, it jumped. And bond market moves like this are not normal. In equity markets, a big move is expected. But in bond markets, especially government bonds, a sharp jump is the market screaming. Now here's something most people miss. Ultra-long bonds behave differently than short-term bonds. Short-term bonds mostly react to central banks' expectation, but 30-year and 40-year debt reacts to something deeper. Confidence that the government will manage spending, confidence that inflation won't spiral, confidence that future debt issuance won't explode, and right now that confidence is being questioned. Then came another red flag. So Japan held an auction of 20 years bond and demand came in weaker than normal. That matters because auction tell you something real. Not what people say they believe, but what they are willing to buy with actual money. Weak demand is like a warning sign that natural buyers are stepping back. And once buyers step back, yields rise faster. Now you might be thinking, okay, Japan yields went up, so what? Here's why the world cares. So if Japan becomes attractive again, money starts flowing back home. And that is where global markets feel the pain. Because Japan has been one of the biggest source of foreign investing for decades. If Japanese investors decide they no longer need to take risk abroad, the US bond market and the US stock market both start to feel that shift, and this is why even US investors should care. Because Japan isn't just a country with debt, Japan is a hinge point in global liquidity. Now, this is the moment where the story stops being Japan news and becomes a global warning. Because the reason investors are panicking is not simply that Japan's bond yields moved higher, it's what Japan represents inside the world financial system. For decades, Japan has played one very specific role, a giant provider of cheap money. Japan's interest rate stayed near zero for so long that the entire world quietly built strategies around it. And the most important strategy of all was the yen carry trade. The carry trade is simple in theory but powerful in reality. You borrow in the money with the lowest interest rates, in this case the Japanese yen, then you take that borrowed cash and invest it into assets that pay more somewhere else. For years that somewhere else was mostly the United States. So the money went into US Treasuries, US corporate bonds, US stocks, and sometimes even riskier markets like emerging market debt. And as long as Japan stayed low rate forever, this trade stayed alive. So it became so normal that it stopped feeling like a trade and started feeling like the natural order of the world. But here's the problem. When Japanese yields rise at home, the trade changes completely. Because suddenly Japanese investors don't need to travel overseas for returns. If you can earn close to 4% on long dated Japanese government bonds without taking currency risk, why would you keep taking risk abroad? And that's the turning point. Rising Japanese yields don't just raise borrowing costs inside Japan, they potentially pull money out of the global market. And when that happens, the first place that feels it is the US bond market, because Japan is one of the biggest foreign holders of US debt. So even the possibility of Japanese investors shifting allocations back home is enough to move prices. And we already saw the early reaction. When Japan's ultra long yield surged, US long term yield moved up too, including the US 30-year yield climbing toward the 4.9% area. That matters because long-term yields set the price of money for the economy. When long-term yields rise, the cost of borrowing rises everywhere. Mortgage becomes more expensive, credit card rates stay higher, car loans get painful, companies refinancing debt face tougher conditions, even the government feels it because higher yields mean higher interest cost on new debt. And in a highly leveraged system, higher rates don't need to rise much to cause damage. It's like adding weight to a bridge that was built assuming the load would stay light. Now zoom out even more. Higher long-term yields don't just hurt borrowers, they also pressure financial markets. They compete directly with stocks because investors always compare risk versus return. So if bonds suddenly offer stronger returns, stocks need to justify their higher risk. And that's when you see equities become shaky, especially expensive growth stocks. But it doesn't stop there. Higher yields also tighten financial conditions, meaning money becomes less flexible, less available, and more cautious. That can slow down economic activity, hiring, and spending. So even if nothing crashes, the environment becomes heavier and harder. So now let's talk about the fear that makes professionals nervous. A carry trade unwind. The carry trade isn't just a normal investment strategy. In many cases, it is built with leverage. And when leverage meets a sudden change in yields, the exits can get crowded. If Japanese yields rise and investors start unwinding positions, it can cause sudden moves across markets. The yen can strengthen quickly, global bond yields can jump, and equities can drop. Volatility can spike, liquidity can dry up. And here's the scary part. This can happen faster than people expect. Because carry trades don't unwind politely, they unwind when people rush for the door at the same time. Now Japan itself is stuck in a situation with no perfect answer. Japan's debt load is massive, around 200% to 250% of GDP, depending on how you calculate it. That has been sustainable for years only because borrowing costs were extremely low. But if yields remain elevated or continue rising, Japan's debt serving cost will eventually climb. And when debt servicing cost rises, budget gets squeezed. The government has less room for stimulus, less room for spending, and more pressure to borrow even more, which only adds fuel to the bond market fire. So naturally the next big question becomes, will the Bank of Japan step in? If the Bank of Japan intervenes to push yields back down, it may stabilize the bond market temporarily. But doing that can weaken the yen, and a weaker yen can raise import cost, push inflation higher, and create new political pressure. On the other hand, if the Bank of Japan stays passive, yield could rise further and market volatility could expand. So Japan faces a tough trade-off: protect the bond market and risk the currency, or protect the currency and risk the bond market. Either way, something takes damage. And that is exactly why global investors are watching this situation like a hawk. Because it isn't just about one election, it isn't just about one bond auction. It's about whether the world's most famous low-rate country is losing control of the long end of its yield curve. And that's a structural shift. And it explains why you have seen investors lean toward defensive assets like gold. So gold doesn't pay interest, but gold often performs when people lose confidence in the stability of debt markets and currency systems. And the deeper message coming from Japan this week is simple. Japan can still spend money, but it can no longer assume borrowing is free. Now as we move toward the February 8 election, every new promise will matter. More stimulus talk could push yields even higher. More tax cut promises could shake confidence further. And the market response will be immediate. Because bond traders don't wait for budgets to pass. They price the future first. So the big question is this just a temporary panic spike, or is Japan about to become the global source of tighter financial conditions? Because if Japan becomes attractive again, money flows back home, and that raises yields not only in Japan but everywhere. And in a world already on edge, that is the last thing risk assets want to deal with.